Hi everyone, this is Paul Hitchcock with Wealth Protector TV, and I'm really excited to have our expert Tapan Patel on with us. Tapan, can you hear me okay?
Yeah, I can hear you okay.
Great. Well, Tapan is one of our top tax professionals, and Tapan, I know you and I were talking offline about the new tax plan that came out of Washington, and there's still a lot of questions that you're getting about how all this stuff works. And one of the big ones you mentioned is something called a 199A. So what is that? Describe that for us.
So 199A is a new section that got added into the new tax law. So basically, 199A is, in simple terms, is a 20% pass-through deduction. So pass-through entities are kind of like S-corps, partnerships, LLCs. It's not for the C-corps because they are not considered pass-through entities. Mm-hmm. So it applies to any income or qualified business income that you get from these pass-through entities, and you get a 20% deduction for the income that you have from these pass-through entities.
So would this apply to people who own rental income property?
Yeah, it will apply to Schedule C's, rental income properties. Now, for rental income, there are different rules how it will apply to them. You have to go through what's called like a safe harbor provision. They have a lot of different provisions that you have to meet to make sure you can take that deduction for the rental properties.
So who is this for? I mean, if you're talking to clients or other people that are interested, who's the target audience that really should be understanding how this works? Is it closely held business owners, or who is it, and what are you specifically digging into to find out if this works for them?
Yeah, so it will help all kind of small business owners, small, medium-sized businesses, even large corporations that are pass-through entities, sole proprietors, freelancers that have like sole proprietors, and real estate property owners. Yeah, so it will help anybody that owns a pass-through entity. And there are some limitations for service-based business or professional businesses. So like say, for example, CPA firms, lawyer firms, doctors, dentists, there are some limitations on when they can take that deduction.
And is the deduction pretty healthy? I mean, is it a pretty nice one? Like, give me an idea of how meaningful it can be.
Yeah, so just give you an example. Let's say you have a business, an e-commerce business, and you end up making $100,000 in net income. It's in an S corporation, or let's say an LLC. Then in straight terms, you'll get 20% of that $100,000, which is $20,000 deduction. And if you're in, let's say, a 30% tax bracket, that's going to save you $6,000 in taxes.
Nice.
So, yeah, it's a pretty nice deduction that you get. Now, again, these are just the general terms. There's a lot of stuff that you need to go through to make sure you qualify for the deduction. But yeah, it could be a pretty substantial deduction.
So if somebody's interested in this and they're getting with you, your upfront scenario will be doing an analysis for them upfront to determine if this applies. Is there that sort of that intake process?
Right, yeah. So we'll look into their business. We'll look into whether they are what they call it SSTB. It's a specified service trader business. So we start with that, and we look at their personal tax return to see what their income would be. And then we go from there to see whether they'll get a benefit of this deduction or not.
Great. Love it, Tapan. As always, great information. Really glad you came on. We'll see you next time.
Okay, sure. Thank you.